Good day, fellow investors. It's time to do a video about the market situation, what is the risk, what is the potential reward with the market, and to see whether we should just invest in the market that stocks always go up or search for other opportunities. The market situation is pretty straightforward. It has been nothing but up for 14 years now, a little bit here up and down, nothing but up. Stocks are closing in again on all-time highs, and whatever someone says that it's risky, blah blah blah, they don't even put it in the media anymore because, as they say, stocks can only go up 10% per year, and everyone who thinks differently is a loser. As long as stocks go up, that is the truth. Why are stocks going up? Well, it's all about interest rates, and yes, interest rates now are higher, but you can see the projections that those will go lower and stabilize at 250. If the Fed's rates are at 250 for the longer term, then a P ratio of 25 for stocks is fair, and therefore stocks go up. Inflation is going down, so that is the key factor to watch because it will give the answer on whether the Fed will be able to lower rates or not. If the Fed isn't able to lower interest rates, then stocks are extremely overvalued. And if we look at inflation, in Europe inflation is 5.3%. In the US, things slowed down to 3%, and if they hit the 2% target from the Fed, then we could see those interest rates decline. But very interesting, and if you listen to Druckenmiller and others, also Ray Dalio, they say that once inflation starts, it's very, very difficult to solve. And now, temporarily, yes, but similarly, in the 1970s, we have seen this decline and then again a huge spike. So we have to check the fundamentals. What is the elephant in the room when it comes to investing, and whether the fundamentals allow for stability, eternal stability, as the Fed is projecting 2% inflation and 2.5% interest rates, everybody happy. The first elephant in the room is that this is how much central banks are printing money, and you can see here that we are now at the turning point, still printing more. The Bank of Japan is still printing more than what is the amount of money exiting the system. And you think, okay, that's the Bank of Japan. Yes, Berkshire borrows here and then buys assets there. So everything is connected in the current world. And then we will see whether ECB is still buying. We will see how will the world look like with central banks taking money out of the system. They have tried to do that for a little bit. You can see here, gray, the Fed, for a little bit in 2019, and then they had to stop that already before the pandemic because it simply didn't work and there were big issues. So most likely that sooner or later they will print money again because there is so much debt, 130 trillion of debt globally, 51 trillion in the US, and look at the spike just after the pandemic in Europe, emerging markets. So it is really crazy how much debt is out there, and that is solved with inflation and money printing. Thus, I think that stability that they project is unlikely to happen, but you cannot predict those things. Another elephant in the room are government finances, borrowing like crazy, borrowing like there is no tomorrow, with the answer being that we will just print money to cover the costs. If you print money, you get inflation, and that is then again something that complicates things a little bit. Another fundamental factor is population. This is for the US, And look at the spike here, where more and more people will be 65 and older. So 24 and younger stable, 25 to 54 stable, 55 to 64 stable, and boom, more and more older people, which do not aid with borrowing for the future, etc., etc. So there are plenty of fundamental issues, and you never know when those fundamental issues will catalyze and become an actual factor that disrupts markets, creates hard times, etc. For now, everything looks good, but in reality it isn't. Spending purchasing power is down 10–20% in Europe and in the States over the last 3 years. You don't really feel it, but it is there. You cannot buy the same things as you could 3 years ago for the same money or for your salary. Yes, it went up a little bit, but not as high as prices. So that is life quality destruction, and I expect a lot of that in the future. How will the Fed, ECB manage that is unknown. Trust me, even they don't know what the future will bring. They can just make projections to keep markets stable, because that is very important, but the fundamentals are simply not there for long-term stability. So when it comes to investing, it's easy to say, Sven, yes, but stocks are just going up, so what are you blabbing about? Well, I'm always about the risk and reward. If I look at the S&P 500 price to earnings ratio is 25. 25, the average historical is around 15. So we have been living in this era for the last 3 decades when stocks only go up, P ratios are high, and everybody happy. But if the Fed's rate isn't 2.5 as expected for the long term, but 5, because of inflation, that elephants in the room that we mentioned, then the P ratio for the S&P 500 will not be 25, but 12 on average, which means when the market overshoots on the down, we can see 8 again, or 10. That is 50% down, which is for me a huge risk. A huge risk to run, especially when you get practically nothing from the S&P 500 dividends. S&P 500 plus, let's say, 3% dividend growth, that's a long-term average return of 4.5%, including inflation. So you will likely have 0 real returns in the long term. And I think it was Druckenmiller that said in 2021 that he expects a decade of 0 real returns. We are now 2 years into his predictions, and we are exactly at 0 minus inflation. We are minus 15% for the stock market in real returns. And the expectation is for that to continue for another 8 years, 5, 10, maybe even 15. So if that continues, what works? Well, investing in a way where you find opportunities that are not correlated with the market, which is based on research, which is based on analysis, which is based on what I share here on YouTube and also on my research platform. Thanks for watching. Many more content coming on opportunities. Another, just one idea, US short-term bonds. If you don't find good risk and reward situations, just put your millions into 5% short-term bonds like Buffett does with 160 billion and wait for the risk and reward to come to you. If you chase rewards, you might get burned, like we'll discuss tomorrow with Adyen investors that got burned heavily for chasing reward and not thinking about risk. See you in the next video.